Hey YouTube! Well, in this video I want to tell you about 3 good-looking dividend stocks that have pulled back substantially from their highs that represent a good value right now. All right, let's get right into it. The first stock that I want to show you is AT&T. Now, if we look at a current price chart of AT&T, we can see that it has pulled back substantially from the high that it made on December 9th, and that pullback has been about 13%. And if we go to their dividend scorecard, we can see their dividend pays 7.46% at the moment with an annual payout of $2.08. The payout ratio is a little high at 66%, but it's not too bad, and their 5-year growth rate is 1.93%. Now, according to TipRanks, based on 13 analysts offering a 12-month price target for AT&T in the last 3 months, the average price target is $32.11 with a high forecast of $38 and a low forecast of $24. So the average price target represents a 13% increase from these current prices. Now, in 2020, their earnings per share fell from $3.57 to $3.18 because of the pandemic, but earnings are expected to start growing again in 2022, and they're expected to come in at $3.24, and in 2023, they're expected to come in at $3.37. Now, I personally think with the tailwinds of 5G and their HBO streaming service that should continue to grow, they should be able to beat these estimates. The big anchor around their neck, however, is their debt load, but they have committed to reducing it in the coming years, and once that is under control, I think the stock will be much higher, so I am happy to be collecting the shares when they are under $30. Now, in recent news, AT&T has agreed to spin off its video business unit, DirecTV, in a $16.25 billion transaction with private equity firm TPG Capital. According to the agreement, AT&T and TPG will form a new company, New DirecTV, with an enterprise value of $16.25 billion, which will include DirecTV, AT&T TV, and U-verse video services. The telecom giant believes that the spinoff will result in more focus, flexibility, and provide more resources to enable the video business to succeed over the long term. The transaction is expected to close in the second half of 2021 and will result in AT&T receiving $7.6 billion in cash from the spinoff and assuming $200 million of DirecTV's existing debt. AT&T expects to use the proceeds from the spinoff to reduce the company's debt load. All right, well, the second one on the list is Pfizer. Now, if we look at a current price chart of Pfizer, we can see that has pulled back quite a bit from the high that it made on December 9th when it made a high of $43.08. And it has pulled back 22% from peak to trough. And if we take a look at their dividend scorecard, we can see their dividend yield is a nice 4.66% with a payout ratio of 46.8%. So that's decent. And their 5-year growth rate is slightly over 6% with an annual payout of $1.56. Now, according to TipRanks, based on 9 analysts offering 12-month price targets for Pfizer in the last 3 months, the average price target is $40.13 with a high forecast of $43 and a low forecast of $36. So the average price target represents a 19% increase from these current levels. Now, Pfizer's earnings dropped from $2.95 in 2019 down to $2.22 in 2020. But they are expected to start growing again in 2021, and they're estimated to come in at $3.33. But they are expected to fall just a little bit to $3.09 in 2022. Now, I think these estimates are conservative, and Pfizer should be able to beat them. Now, one of the biggest tailwinds for Pfizer right now is their COVID vaccine. Pfizer has already reported $154 million in sales for their vaccine in the fourth quarter of 2020. Now, Pfizer projected that the vaccine will generate sales of around $15 billion this year, and gross profits will be split equally between Pfizer and its partner BioNTech. However, that projection was based primarily on the number of doses that Pfizer was contracted to supply as of early February. Since then, the company has secured additional supply deals, one with the U.S. for another 100 million doses and another with the European Union for another 200 million doses. More supply agreements could be on the way, and Pfizer CEO Albert Bourla said that a durable COVID vaccine revenue stream similar to the seasonal flu is likely. He mentioned the potential need for regular booster shots to maintain immunity, as well as a possibility for booster shots to combat new COVID variants. If Bourla is right, Pfizer could be showing investors big money with their vaccine for years to come. All right, well, last but certainly not least is PPL Corporation. Now, if we look at a current price chart of PPL Corporation, we can see it has pulled back decently from the high that it made on November 24th when it made a high of $30.80, and that represents a pullback of approximately 15% from top to bottom. And if we take a look at their dividend scorecard, we can see their dividend yield is a nice 6.34% with an annual payout of $1.66 and a payout ratio of 67%, which is pretty good for a utility company. And they have a 5-year growth rate of 1.95%. Now, according to TipRanks, based on 4 analysts offering 12-month price targets for PPL Corporation in the last 3 months, the average price target is $32.50 with a high forecast of $34 even and a low forecast of $30 even. Now, the average price target represents an over 20% increase from the current levels. PPL Corporation's earnings fell off slightly in 2020 to $2.40 per share from $2.45 per share the year before, but they are expected to grow again in 2021 with estimates coming in at $2.46 per share and estimates in 2022 coming in at $2.60 per share. All right, well, those are the 3 dividend stocks that I wanted to show you guys, and as you can see, all 3 of them are in downtrends, so odds favor they're probably going to go lower. And I think these companies are rock solid, so I don't think they're in any danger of cutting their dividends just yet. So if the price goes lower, that makes their yields even much more attractive. And PPL, I do not own. I do own AT&T, and I don't own Pfizer, but I am very interested in grabbing some PPL if it gets anywhere near $20 a share. Thinking about starting it already because the dividend yield is already over 6%, but if it gets anywhere near 20, that's going to put it well over 7%, and that is a great yield to get from this rock solid company. So I don't know if I'll be buying them just yet, but I would keep my eye on them, and if they get cheaper and nothing substantially bad happens to their business, they should be great pickups for a dividend investor. Well, all right, let's get into some of your guys' questions before I close out the video. First one was from my good friend Yashin. He wanted me to check out RMO. Romeo Power, I believe they are in the EV battery space, and they have had a huge, I haven't seen this one in months, but they have had an enormous pullback from almost $40 a share, and they're all the way down to the 200-period simple moving average at the moment, and it looks like it is having a hard time getting above it right now. So I think this thing is mired in a pretty steep downtrend. Honestly, I don't see any signs of life from this chart as of yet. It's obviously going to have to go sideways a little bit longer and hopefully get above some of these moving averages before it can start any kind of a decent uptrend. But Yashin, if you are in RMO, I don't see a whole lot of good things in this chart. If you're just thinking about getting into it, I would probably sit on the sidelines a little bit longer, wait for it to make a little bit more of a constructive pattern so you can get in on this thing when it starts to move up. The next one I want to get into is mine. This was from Epic. Oh, that is the wrong one. How about mine? Let's try mine. There we go. Okay, mine is, I don't know anything about this company. I wonder if they're in the Bitcoin mining space. I would imagine they probably are because a lot of these lower priced penny stocks have the same exact pattern during these same couple of months. So it wouldn't surprise me one bit if they are in the Bitcoin mining game. If you were thinking about getting into this stock and maybe catching another wave in the next cryptocurrency wave up, it's actually a pretty good time to buy it as far as I can see. It has a nice pullback after this big move up. I don't know if there's going to be another big move up into this, but if you wanted to take a shot, if you're not holding it already, this is not a bad time to be entering. And then, of course, if you get that move up, you're going to be in Fat City. But if it starts to pull back below this 50-period simple moving average and continue to fade, then you're probably going to want to get out of it. Now, if it does make that pattern and start to go sideways like it was doing before it had this huge move up in February, then you know it's making another constructive base. And if this is in the Bitcoin space, I'm just guessing here, but if it is in that space and they start to get more momentum, this thing could definitely have another move up. But I think if you're thinking about entering it right now, this is not a bad place at all. This is a pretty low risk area. It could probably fall down another, if I was getting into it right now and it fell down probably another 30-40% with no signs of life, probably just take my small loss and move on. But you definitely don't want to be chasing it up here. You want to be buying these pullbacks when you can find them. So those are my thoughts on MINE. The last one I had was a question from Tony. He wanted me to take a look at SYN. SYN is one I had on my channel that I bought before, and I got rid of it once it crashed below this 8-period exponential moving average, and it doesn't look like it's showing any signs of life right now. It's stuck below that 50-period simple moving average. And once stocks get below that average, it takes a lot of work for them to get back above it usually. So usually when it gets below that moving average is when I just cut ties. Usually I'm out, but even before that happens, it depends on how far away it is. But unfortunately for SYN, when the market turned around and crashed, it wrecked this chart pattern, and that's the risk you have when you're buying some of these patterns and the market does crash, because it will destroy chart patterns. And the chart patterns is what everybody is pretty much thinking. So once this chart crashes like this and the chart breaks, then probably a lot of the players that were looking to get in right around this level, they're not looking to get in anymore because the pattern is broken. So as far as SYN goes, I would probably get out of it. I know it sucks to sell at a loss, but if the chart pattern is broken, you might as well take your hard-earned dollars and put it into a better looking stock. And you got to look at the bright side. When a stock does pull down and you have to take a loss, you can use those losses to offset gains. So it's not necessarily a terrible thing to take a loss, especially if it's a small one. It does hurt the ego to take a loss, but honestly, from a trading perspective, if you take that small loss and put that money to work in a better looking stock, a better looking chart pattern, you're probably going to come out better more often than not. But those are my thoughts on SYN. If you want to hold on a little bit longer, since you've already rode it this far down, I would probably consider getting out if it broke this low of 62 cents, because if it breaks that low of 62 cents, chances are it's going to fall easily to the 200-period simple moving average. That's just going to create a bigger loss. So I don't know how big your position is, but taking a loss isn't always the worst thing in the world, and nobody's perfect. Everybody makes a mistake, and especially when you get blindsided by a market correction like that just wrecks chart patterns. That's not your fault, because if you were buying this chart on this pattern right here, chances are that pattern is usually going to play out to more upside. But unfortunately, we got crushed by the market. But those are my thoughts on those 3 stocks, guys. All right, guys, well, that's all I have for this video, so I'm going to end it right there. But if you have any questions about any of these stocks, or if you have any other stocks you want me to take a look at, please leave them down there in the comment section. I will get to them as soon as I can. If you enjoyed the video, please hit the like button for the YouTube algorithm and subscribe to the channel if you haven't already. Thank you so much for watching my video all the way to the end, guys, and until next time, take care.